Hey everybody, Tanner Cole with Coluxe Realty here. I'm sitting with Dean Reiber with Zenith Home Loans, and we are going to talk about assumable loans. So I get a lot of questions as a realtor. Is this loan assumable? What does an assumable loan mean? Can I do an assumable loan? I hear great things about assumable loans, and we are here to talk about the pros, the cons, the possibilities, whether or not it'll work for you. And Dean, take it away.
Okay. Well, Tanner, thanks for coming in. Let's talk about this. So there's a lot of assumptions people make about assumable loans. Probably the biggest assumption is they're just going to take over somebody's mortgage and it's going to be easy, and that's the way it is. But it's not quite that easy. And I think we're going to walk through a few things today, tell you what's good about them, because there are some good things if it does work for your situation. We'll tell you what's not so good about them, because there is some downside to doing an assumable loan. And we'll walk through a scenario, compare just going out and getting a mortgage today versus taking over an assumable loan. As it states, an assumable loan means that you're going to assume or take over a mortgage that is in place. So if someone did their mortgage 3 or 4 years ago, you're just going to take over wherever that mortgage is today. You're just going to take it over, right? Yep. But there's a little bit more to it than that. Not all mortgages are assumable, so there's only certain ones that are. So we'll talk a little bit about that as well. And every situation's different. So we're going to hopefully go through, give you the basics. Hopefully you'll have a good understanding. If you're a realtor out there, you'll have a better understanding when you're talking to sellers and buyers of what would it mean to do an assumable loan. And if you are a buyer or seller out there, you're going to have a better understanding of what that looks like if you're buying or selling a house. So,
okay, well, let's hop right in and see what we got. So what is an assumable loan?
So what do they look like, and what would they look like for you? Really, there's lots of different types of mortgages. People know conventional mortgages, jumbos. There's all sorts of different ones. The ones that are typically assumable, or the ones that are eligible to be assumable, are either an FHA loan, which is backed by the Federal Housing Administration, the VA loan, which is backed by the Department of Veteran Affairs, or a USDA loan. That's typically more of a in rural areas we see that. And that's backed by the U.S. Department of Agriculture. And so there's a lot of similarities related to those three different loans. The most common one is they're backed by the government.
Right. So we don't need to go through each one individually. They're similar enough that
correct.
It'll apply to all of them.
Correct. And we'll kind of talk through that. But let's talk a little bit about what are the pros for taking over an assumable loan.
And before we go to that slide, I just want to kind of point out here that most buyers think that FHA means it's a first-time home buyer thing, but it's not.
No, it's not.
Yeah. So I don't know why people think that, and we can make a video on that at some point, and it's probably a good idea that we do, but it is not just for first-time home buyers.
Yeah. Okay. And a VA loan is strictly for veterans, although I do want to point out that a VA loan, you do not need to be a veteran to assume a VA loan. Right. Most people think that, even realtors out there think that you have to be a veteran in order to assume a VA loan. You don't. You can be a regular Joe off the street, and as long as you're qualified, you could assume a VA loan.
So for now, we can just move on to our
the
pros of an assumable loan.
Yeah, let's do that. So in a high rate environment that we find ourselves in today, now, if you're watching this video and it's 20 years from now, who knows what the rates are, but in 2023, when we're filming this, we find ourselves rates in the 7s, 8s, kind of hovering back and forth. So pretty high, but if we look back just 3 or 4 years ago, rates were in the 2s and the 3s. So there's lots of people right now that are sitting on very low interest mortgages that don't necessarily want to let go of them, But if they did have to move, they did have to sell, could be attractive for a potential buyer if they could assume their mortgage, because they could assume a mortgage in the threes as opposed to paying 8% or 7% for one. So the other advantage of a assumable mortgage is you have capped closing costs. You typically don't have to pay for an appraisal fee. You typically don't have to pay the lender a fee. You don't have, the title fees and all that type of thing. So you have very limited closing costs when you're assuming a mortgage, and you get some long-term savings. You think about it this way: if someone got a mortgage 4 years ago, they've made 48 months worth of the payments, and so you're going to pick up that loan where they left off, basically, right? And you're going to take over whatever payment they have. So if they have a very low interest loan, that could be saving you quite a bit and a lot of money going towards the principal, as opposed to if you had a higher interest loan.
Well, let's just stop here, Dean. Let's just say that everything's great and everybody should do this.
Well,
but
now, we like to speak the truth there.
Yeah, there are some cons to it.
So let's talk about what's not so great if you're going to assume a loan. Well, first of all, one of the biggest assumptions that people make on assumable loans is they're just going to take over that mortgage, Tanner. They just think, I'm just going to take over this 3.5% mortgage and it's all going to be good. Well, if I'm the seller, I'm going to want what my house is worth today, not what
you're
I
going to
owe
want your
on
equity,
it.
right?
Correct.
Yeah.
So that means as a buyer, I'm going to have to bring that money to the table. Right. And unfortunately, there's only two ways I can do that. Either I have the money and I'm going to bring that to the table, or I'm going to have to borrow the money. And we'll get a little bit more into that. Sure. But with the type of equity people have seen over the last 3 or 4 years, it could be substantial.
Sure.
The other con is mortgage insurance. It was very common for people with a low interest rate to not put 20% down and put less than that down. And so in many cases, some of those loans will have some mortgage insurance attached to it. That's going to be part of what you're going to be paying on that. So the third downside is you are at the mercy of the current loan servicer. They're not highly motivated to do an assumable mortgage. Right.
I mean, I've heard as much as 6 months, maybe even a little more.
Yep.
To assume a loan.
Yeah, that's one. It's not going to be a high priority for them. Right. Two, they're going to be pretty stringent on the buyer that does want to assume the loan. They're going to want to make sure that there's no red flags whatsoever with them taking over this mortgage. Because if they have a 3.5% mortgage sitting on the books and they could do one at, let's say, 7%.
Yeah.
As a lender, 7% interest is better than 3.5% interest.
Right. So basically, if they've got two loans sitting on their table that they're working through, the one that is an assumable loan is going to go to the bottom of the pile every time.
Yep.
The other one's always going to take priority over it, which is why it can take so long for it to go through.
Correct. So when you do an assumable loan, you're going to need to bring not only money, which we talked about, you're going to need time. Right. So if you're a seller and you want to sell your home quickly, or you're a buyer and you want to get into the home of your dreams quickly, an assumable mortgage is not going to be quick by any means. We have current clients right now that are anywhere from 2 to 6 months that they've been waiting to get final approval on it. And it doesn't mean just because it's an FHA, a VA, or a USDA loan that the servicer is going to let you assume the loan.
So they can just say no outright, like, this is not assumable.
It's at their discretion. Sure. But those are the only ones that typically are eligible to be assumed. Sure. And there's not a lot of incentive for the seller, especially if I'm a veteran and I have a VA loan. As I said, my entitlement's tied up in that loan. So if I want to get another VA loan, I would have to either have additional entitlement, and we won't get into VA loans right now, or I'd have to have another veteran that has entitlement that would release that back to me so I could go get another VA loan.
Okay.
So there's some additional steps there.
Sure.
So unless it happens that I'm really having a hard time selling my house and I'm okay with it taking a while to get it processed, as a seller, I'm probably not going to offer for you to assume my loan.
Right.
I would rather just you go get a loan and let's move forward from there.
Yeah. All right, so that's the pros and cons. Now we can get through the scenarios that we kind of put together. So keep in mind, this is Colorado, so this is all very relevant to Colorado, but there's certainly other places where it's very similar numbers that you would see. So this is the basic scenario, and I'll let Dean talk through that.
Okay, so what we did, Tanner, was we took a step back in time. We went back to the year 2020, right? Remember 2020?
Oh, it was fun.
Gosh, good times. But back in 2020, if you helped a buyer buy a home or sold a home, but in this case, let's say your buyer bought this home at an average home price would have been $521,950. If we fast forward to today, that same home would be worth $715,000. So for this scenario, we're going to assume that the current owner of the house bought it for $521,950, and they're putting it on the market at $715,000.
Okay.
So his original loan, or their original loan back in 2020, would have been at a rate of 3.875 on an FHA mortgage. Now, 3.875 sounds pretty good in today's market, right?
That'd be nice.
Now, as I had mentioned before, an FHA loan typically are borrowers that don't have a lot of money down and typically maybe have, a few dings to their credit. So we're going to assume that they put 3.5% down on this mortgage, right?
Right.
That would have left them with a loan balance in 2020 when they closed of $503,000. So fast forward to today, they've made 43 payments. And they've paid down the balance down to $412,633.
Okay.
Right? And so that loan that you're going to assume is going to have a balance of $412,633, and you're going to have another 317 payments remaining on that loan if you stay in that loan.
Okay. I believe the first scenario is if you just got a new conventional loan with 20% down.
Correct.
This is what that would look like.
Yep. So if you just went out and said, I'm just going to get a mortgage, I'm going to put 20% down so I don't have mortgage insurance. Your purchase price is $715. Your loan amount's going to be $572,000, and you're going to bring roughly a little north of $147,000 cash to close. And you're going to have payment around $44.70 a month.
Okay. And this is the type of loan that most people are used to. This is the most comfortable scenario for sellers and buyers. This is what everybody knows, especially if you've bought a house before. This is what everybody's used to. Agents, lenders, buyers, sellers. This is the most common thing to happen.
Correct. And if you own a home today, and let's say you're buying your replacement home, right? You're typically going to have some proceeds. You're going to have your equity that you're going to be able to do that.
Right.
So you're going to use part of that for your cash to close on this new one.
Sure. All right. So the second scenario is an assumed loan with a second mortgage to cover the seller's equity.
Correct.
Yeah.
Correct. So in this scenario, we're going to assume that the person that wants to take over that assumed mortgage doesn't have an excess amount of cash.
Right.
They're going to have to get a second mortgage, right? As I mentioned, your options are you either have the money or you're going to have to borrow the money. In this scenario, they're going to borrow the money. Now, what that looks like is they're going to get a second mortgage. That mortgage is going to take a subordinate position to the first mortgage. Hence, the lender's probably going to want a little bit more of an interest on that second mortgage than on the first. So you're going to pay a little bit of a premium on that. And every lender's a little bit different. Not every lender does second mortgages.
Sure.
Not all lenders will go up to 95% or 97% financing on it. Some of them will only go to 80%, and you'll still have to come up with the difference. So every situation is different. But in this scenario, we're going to assume that you can get as much as you can on that second mortgage, so you have as little out of pocket. So you're only bringing about 20 grand cash to close and do that, right? Your loan amount is going to be a little more than $697,000 on a $715,000 purchase. Mm-hmm. So you're borrowing most of the money to get the home, right? Right. And your monthly payment's going to be a little more than $5,800. So if I compare that to just going out and getting a conventional loan, it's going to cost me about $1,351 more to assume the loan and get a second mortgage.
Right. Okay. And then the final scenario is kind of the ideal situation. You have the cash to cover a down payment and to cover the seller's equity.
Correct. And really in this case, it's not even a down payment, Tanner. It's just you're buying the house at $715,000. They owe $412,633. That's what you're assuming on your loan amount. The difference is what you got to bring to the table, right? Yeah. So in this case, you would need $304,000 and some change at the closing table. Yeah. Now, not everybody has that. And as I said, the two things you need in an assumable situation is you need money and you need time. So this assumes that you have time to go through the process and wait 2 to 6, maybe even more, to close on that home. The upside is you're going to save around $1,600 over just getting a conventional mortgage today. And so that could be pretty substantial over time.
Right. So this is kind of the scenario that everybody has in their head, is that they're going to save $1,600 a month by assuming someone's loan, and the part that they often overlook is the cash that they will need to do so.
Yeah, they often forget that I'm going to have to come up with $300,000. Right. And I had this question yesterday from a buyer. He said, what if the house appraised at $730,000? Would I still have to come up with $304,000? Yes, you would, because the asking price is $750,000. Yes. Now, in that scenario, you have some instant equity and some additional instant equity because your $304,000 will go straight to equity in the home. Right. But yeah, it's based on the purchase price or what you pay for the house, not what the house is worth.
Right, and that's that kind of, kind of backwards, but it leads us to the other scenario in which if you don't have the money, that's when you take out the second loan.
Correct.
To cover that $304,000.
Correct.
So 20.
So depending on how much you have to borrow on your second, that's going to determine whether or not it's financially advantageous for you to assume the loan or not.
Sure. And I would go ahead and I would assume that the person that's able to do this is someone that is selling a home in which they have the 304 in equity, right? I mean, it's most people aren't going to have that just in cash sitting in the bank. It's going to be in a 401k or something, an investment account, and you very likely would have extreme penalties for taking it out of that type of account to make it a cash down payment. So
and they have someplace else to live for 6 months while they close this out.
And in that, now correct me if I'm wrong, but on that 6 month wait, at any point they could just come back and say no.
Correct.
So you might be waiting for 5 months just to get a no, and then it's a no anyway.
Yep.
So then you're right back to the drawing board. You're back to looking for another house. You're starting your search over. You're falling in love with a different house. It's just it's not ideal.
Yeah, it definitely can be a very frustrating experience.
Sure.
So
it kind of reminds me of when we were doing a bunch of foreclosures and stuff, 10, 15 years ago, and you were basically like, you were under contract on the foreclosure, and then you're waiting, and then the bank just says, nah, we're going to foreclose on it.
Correct.
And it's like, oh, and then it's over, and you're moving on.
Well, and think of it this way too. let's say you get 5 months down the road on waiting for this assumption. That's 5 months that all the houses that you might have bought
yeah,
would have appreciated.
that's true. Yeah,
And so it's there is some risk involved
Right.
with going down this path. And for the select few, it could pay off.
yeah. In fact, I ran numbers yesterday for my neighborhood in Castle Rock, and we are the average closing price on a home in Castle Rock is still up 7% from the same time last year.
Well, my recommendation to anybody that's thinking, if you're thinking about selling your home and letting someone assume your loan, if you have one of those types of loans, or if you're a buyer thinking you want to go buy a home and try to assume their loan, I would definitely make sure that you have a great realtor like Coluxe Realty,
That's right.
or a great lender like Zenith Home Loans working with you.
Well, that's kind of it for today on the assumable loans. But thank you, Dean, for being here and talking us through this. And if anybody's in Colorado and looking for homes and wants a knowledgeable team to work with, then you're looking at them. Tanner Cole with Coluxe Realty and Dean Reiber with Zenith Home Loans. I almost said the name wrong, but I didn't. And we're always here and we're always available, and we'd love to work with you.
Reach out to us. We'd love to help.
Yep. Thanks, guys.